Hi, everybody. This is Andy Lebow from Commodity Research Group. Today, I'm joined by Marty Stetzer, the president of EKT Interactive, and my partner, Ed Meir, also of Commodity Research Group, and recently named the #1 base metals analyst by Metals Bulletin. Today we have a program, our weekly program. We're going to talk, Ed is going to lead off, and he's going to be talking about metals, of course, also the dollar, a little bit on trade talks. And Ed, maybe you can give us some clarity on Brexit.
Sure. Yes, I have all the answers here.
I'm sure you do.
You mean like everybody else has all the answers too, right?
Right. But Ed is going to talk a little bit about Brexit, and then I'm going to do the anchor leg with Marty on oil. So I'm going to start it off with my colleague Ed Meir from Commodity Research Group. Ed?
Thanks very much, Andy, and thank you, Marty, for organizing this podcast. We are looking at a couple of things over the next week or two, of which Brexit, as you mentioned earlier, is going to be kind of important to the markets. The problem is no one really knows what's going to happen. As of yesterday, Parliament apparently is going to be voting on 16 different proposals. I'm not sure all 16 will be voted on, but I think there's 16 different combinations and permutations of Brexit that are going to be voted on. This is basically a move to take away the agenda, so to speak, from Prime Minister May and bring it back to Parliament. Parliament hasn't been happy with the fact that, you know, she's kind of cloistered all the negotiations within her office. People aren't really getting much details or much input into what she's agreed to. So they want to open it up to a vote on different options. The problem is there is not going to be a majority for any of these plans. So April 12th is a key cutoff date. By that point, the UK has to tell the EU what kind of plan it's going to put forward. If it doesn't come up with a plan, it's basically going to be out of the Union in a hard Brexit by May 22nd. So all in all, that's a lot of detail, but as far as the markets are concerned, sterling is not doing very much. It's firmed up actually over the last day or two. It's now at 132. Again, I think markets just don't know what's happening. It's really literally an hour by hour type of a thing. We could even see her resign. So we're watching that carefully. I think eventually there will be some sort of a deal that should strengthen sterling. The talk is that it could rally maybe to 135 to 140 from 132 right now. And if there is no deal or no Brexit, we could maybe drop down to around 125. So we're watching that. Item 2, the trade talks. The U.S. Trade Rep Lighthizer and Secretary Mnuchin, the Treasury Secretary, are both in Beijing today. Another round of talks with the Chinese. I don't think anything will happen this week because there'll be another week of negotiations next week in Washington. Which suggests to me that this thing is going to take some time before it's resolved. Stock markets seem to be, taking things in stride. We've kind of had a bit of a sideways move in equity markets over the course of March. The Dow hasn't really done very much trading between 25.4 to 26, more or less. It's a much tighter range than in February and January. Bumping along resistance. Turning to base metals, again, very sideways action, kind of the same in a lot of markets as Andy will talk about later. But copper, aluminum, zinc, trading at relatively high levels, but the rally has sort of run out of gas for now. And we are kind of just stalling for the moment. And I think we'll see more of the same going into April. Finally, gold has had a good run in March, relatively good. It got to a low of 1280 early on in the month and got up all the way to 1320, so about a $40 an ounce move. It's retraced a little bit over the past 2 days, but we still think gold could do a bit higher because the dollar seems to be weakening dramatically, especially now that the Fed is on hold and reiterated its very dovish message last week, saying that they're not going to be raising rates at all this year. In fact, talk is that there will be a rate cut this year. So I think that's kind of bearish for the dollar short term. That should help give some support to most commodity markets, probably including crude as well to some extent, certainly to gold, certainly to silver. Platinum and palladium have started to move on their own accord, on their own steam. They've kind of decoupled a bit from gold and silver. Platinum has been kind of the laggard compared to palladium, but it started to move over the last 2 weeks. But palladium, as we speak, is finally in the midst of a rather substantial correction. So we've been calling for that for some time now. It seems to be happening. The charts are not looking as good as they were. We've had a $50 move down, $60 move down so far today, and a $40 move down yesterday. So finally, we're starting to see palladium buckle a bit here. And, we've been talking about that for the last couple of weeks, so it's finally starting to happen. Well, I'll turn it over to you. I don't know if I left anything out, but net, kind of steady range markets envisioned for April, nothing dramatic on the up or downside till we work through some of these uncertainties.
Okay, thanks, Ed. That was a really great summary of what's going on in many markets. I'm going to talk a little bit about the crude market, as well as actually a lot about gasoline. But let's start with crude. As Ed mentioned, crude's been trading in a narrow range and has a narrow range, but moving up. In fact, we just about made a new high for the year yesterday, and as we had expected, actually, we were looking in our last monthly report, we said that we thought crude could get over 60 and possibly up to 61. So that was a pretty good call by us on crude. But the real story has been gasoline. And once again, we had a bullish report on EIA weekly report today on gasoline with the draw of 2.9 million, which is around what the market was looking for. Gasoline stocks have now drawn by 20 million barrels since February 8th. Now, part of that is seasonal as winter grade has moved out, but that is a much higher than seasonal draw. And really what's happened is refiners have had a hard time returning from turnarounds. There have been problem after problem, particularly in some of the larger Gulf Coast refineries. And as a result, gasoline production is well below where it should be. Earlier this year and late last year, and almost all through last year, we were worried about gasoline because supplies were more than ample. And now we're going to the season with basically average supply numbers at 26 days versus the 4-year average is 26 days. So refiners are really going to have to start getting their act together. The turnaround should have been over by now. We look at crude runs; they're averaging only 16 million barrels a day. Last year, they were averaging 16.8 million barrels a day for the 4-week average ending now. So refiners, they're just not, they haven't been able to get their plants up. Eventually, they will, but in the interim, it means that gasoline is tightened, refinery margins have improved, and that, of course, has helped I think the underpin to a certain extent the entire picture in crude, and I know the market isn't focused on it whatsoever because the market has really been focused more on the macro, rightly so. And as Ed mentioned, the uncertainty in other markets. We, of course, have some major uncertainties in our market from a geopolitical standpoint, with Venezuela still having major problems. Now their infrastructure, which has already been collapsing, is going into a further collapse as the power outages are really interfering with crude production. They're having trouble sourcing ships. So, I think their crude production, we'll see where it comes out. But I think it's going to go, I think we're looking at about 800,000 barrels a day, maybe even lower, versus just a couple of months ago at 1.2, 1.3 million barrels a day. So things continue to, it just continues to erode badly in Venezuela. And of course, the big decision coming up is on Iranian sanction waivers and where the administration is going to go. That needs to be decided by early May. The administration has been talking about getting Iranian exports down to zero. They're right around 1.2 to 1.3 million barrels a day. Looking at the supply-demand numbers, we actually need Iran to be around here. As it is, crude is pretty tightly balanced right now. Second quarter, I think there's going to be a draw. Third quarter, there's going to be a draw. And, if we were to lose like another 500,000 barrels a day of Iranian crude, it's not exactly clear where that's going to be replaced, unless the Saudis step up and start increasing production, because U.S. production is not going up 500,000 barrels, is not going up 500,000 barrels a day. So, the market looks tight, and it's also shown in the, if you look at the curves, every single market except the first 3 months or 4 months in WTI is heavily backwardated. So you look at the curves, and it's expressing what we see, what we think. Things are really tight, and under that scenario, it looks to me as if there could be some more upside here on the crude market.
Andy, I just have a quick question on Venezuela. Is anyone actually buying their crude now? I mean, how can you even buy it with all these sanctions in place, and who is buying it?
Well, the Chinese are buying, and the Russians are buying.
Right.
So those are, and there's Europe. No, I mean they're backing out. So
it figures they're the ones with the most invested in there in terms of loans and stuff like that.
Yeah. So China and Russia have been
right
buying, but there's going to be less and less available because they can't get it out, and they can't because of the sanctions. Insurance on ships is a big issue,
right? And
that's a heavy, as we've talked about. That's a heavy crude that a lot of refineries really demand, particularly here in the U.S. So the U.S. has replaced some of the Vens with Mars, actually, which is an offshore grade, a medium. So medium sours are replacing the heavy sours.
And Andy, I think we talked last time, Ed, that they may not be paying for this crude because they have such a debt load. Venezuela has such a debt load with both China and Russia, so it may not be helping any of their foreign exchange situations.
Right.
Probably not. Yeah, I mean, these are all repayments to Russia and China, and even if Maduro was to fall, it's not clear how quickly they can get their their decrepit infrastructure up. It's going to take many months, if not years, to get going. But at least they'll be able to export. One last thing that I wanted to add on, on the EIAs and crude. we look at crude inventories are basically running below the 4-year average by 30 million. We're at 440 million barrels. The EIA in their short-term energy outlook had us at 480 by the end of March. So they missed by 40 million barrels. Ed, I know I could do better. Ed and Marty, I know I could do better than that. But, it means that because the EIA was also forecasting this big, oversupply of domestic crude, and it's not going to happen. So that's another, I think another supportive factor. And the demand numbers too, they've been coming in okay. They're not rip roaring, but they're not really fading. Yeah. So, to sum up, I think crude. I think the petroleum complex looks, still looks pretty constructive, and we still have some upside here.
Andy, if I can go back for a minute to the gasoline story you were giving.
Right. Please, Marty.
You quickly mentioned the change from winter grade to summer grade.
Right.
And a number of folks on the EKTI network are new to the industry. So let me take a minute and you and I can exchange some of the background on gasoline. A lot of people don't know that gasoline basically is only one component that comes out of the crude oil. A lot of the other components are heavier or fuel oil, and a lot of the refinery units are basically trying to destroy fuel oil and make gasoline. So with that in mind, it's a very complex operation. So there is a system in the refinery called gasoline blending. And over 30 components go into the gallon of gasoline that you are putting into your car. In the winter, one of the components that is added to help cars more easily start in cold weather is butane. In the summer, the butane is too volatile and is taken out of the gasoline blend. So this is the term that Andy mentioned earlier, the difference between the winter grade and the summer grade. So Andy, if you can go in for a minute as to when they start switching over and what kind of impact that sometimes has on the market, I think that would be helpful to our listeners.
Right. There's always a premium for the for summer grade because, as you mentioned, it's more expensive to make depending on the blending operation. So oftentimes, when you're looking at a gasoline curve, you're always going to see March gasoline at a pretty good discount to April gasoline, April futures. April futures is the first spring month, spring-summer grade month with the lower Reid vapor pressure, and it continues to go lower throughout the summer, and it is more expensive to make. So you're always going to see winter grade gasoline price lower than summer grade, and of course, wholesalers, the dealers have to prepare by by liquidating their winter grade stocks and moving into their summer grades. I think May 1st is the where they have to have it at the or April 16th. I'm sorry, April 16th at the pumps. So there's always going to be a differential between winter grade and summer grade.
And there's also a logistics aspect of this changeover, as you alluded. Not only the refiners have to switch the grades, but every terminal, every distribution point, the gas stations themselves finally have to make sure that they have the correct summer grade in before people start driving to the beaches.
Right. The gasoline, and again, you'll see this big gap if for the chartists, getting back to the future side, for the chartists, you always see a big gap up for when March expires and April becomes spot, and the first winter grade similarly, September is the last summer grade contract, October the first winter grade contract, and the RVP read vapor pressure numbers increase from September, October, November, December, et cetera.
Thanks, Andy. That was very, very helpful.
Thank you, Marty, for bringing that up. But again, I think, there's been so much focus on, on crude and the geopolitics. It's nice to talk about, some of the real, because some of the real, what is made from crude, because crude, doesn't really have very much use, other than running it through a factory to make, to make products. Well, Marty and Ed, thank you very much. You can find us on www.commodityresearchgroup.com. If you have a question, please email me, Lebow, at commodityresearchgroup.com. Marty?
Thanks, Andy and Ed. Always enjoy the sessions and, of course, learn something every time. If you're new to the industry or you're a trader that really doesn't understand what goes on inside a refinery, be sure to go to our website to learn how the industry works at www.ektinteractive.com. Thanks again for the opportunity to participate.